George of the jungle, strong as he can be.
George, I don't have any debt. What are you telling me that my debt ratios are too high for the house that I'm trying to purchase? That's a common question that I get in the creditjungle.com, and we're going to be explaining that a little bit today. My name's George Anderson. Thanks for joining. And a lot of people who are, first-time home buyers, and you see this a lot with a lot of millennials. A lot of them are very overly credit cautious. I mean, if they've been able to stay out of student loan debt, and save up some money, I mean, they're very good about gathering a lot of information on the internet, but then they typically will rely upon a family member to refer them to a professional, but then they get questions that to them don't make any sense. And so one of the things that I get a lot of times is that somebody who has very little debt, let's just say they have a couple of credit cards, and maybe that's it, no student loans, no vehicle debt, no nothing else, they've saved up their money, and then they find out that the house that they want, they really can't have it because their debt ratio is too high. So let's talk about how those debt ratios are calculated. And the first thing, we're just going to take an example here of a young couple. Let's just give us a nice round number. Let's just say that we have a household income of $5,000 per month. So that's our income. And the home that they are looking at, just whatever type of loan it is, whatever their down payment is, it's going to have a house payment of $2,000 per month. So we have a $2,000 per month, and this includes everything. This is taxes, insurance, principal, interest, and if there's mortgage insurance, we have to include that. And if they're looking at a townhome or a planned unit development or a condo, there's going to be an HOA fee, a homeowners association fee. That is also included in this housing expense ratio, but it's not made with the mortgage payment, but it's part of the housing expense because the condominium can actually foreclose on you if you've been making your mortgage payment but haven't been making your HOA dues. You can actually get into default on that, and they can come back and do that. So that's considered an obligation. That's part of the housing expense. So anyway, we've got a $2,000 a month housing expense here, and the couple's saying, well, we don't have any debt, that we should just be fine. Well, you're proposing, though, to get into debt, okay, whatever this loan amount is, if this is a $300,000 loan or whatever the circumstances are. Well, what percentage of your income is this house payment going to be, okay? So we have what's called a front ratio or a housing expense ratio. So we have this front ratio here on this is going to be 40%, okay? Because we have $2,000 is 40% of $5,000. Now, if somebody has good credit, depending on the type of loan that they're applying for, 40% is actually tolerable. That's going to fit within there. But what if your income is $4,000 a month? Well, now the housing expense is going to be 50% of your debt ratio. You're not going to be able to get approved for that even though you have no debt, okay? Now, the second scenario on this is, well, how do the other debts that somebody has, how do those calculate into that total debt to income ratio? Because maybe their housing expense ratio, and if they have no other debts, then they have what's called a total debt to income ratio or the back ratio, okay? If somebody has, zero debt, okay, if they have zero other debts here, then the back ratio is 40% as well, because they have 2,000 plus 0, okay, divided by 5,000 is 40%. Well, what if somebody has, with, let's just say, student loans, which we still have to count a minimum payment, even though student loans are in deferment until January 1st, depending on the type of the loan, you've got to count either the actual payment on the credit report, 1% of the balance, or 1/2 of 1% on the balance. I'll do a separate video on student loans and how to calculate those payments. But let's just say that they had $1,000 per month, okay? And those are their other debts. So what is their total debt to income ratio here? Well, we have 2,000, which is the housing expense ratio, plus 1,000, and these are the other debts. These are debts on the credit report, okay? This is not going to count child care. This is not going to count your cell phone. This is not your utilities. This is not taxes. Okay, this income figure here is the gross income, not your net. Okay, so just to clarify a couple of those numbers, the total debt to income ratio for this scenario is 60%. Okay, we don't have a conventional FHA or VA loan program that's going to let you go to 60% debt to income ratio. Under this scenario, this would be the limiting factor here. Okay. Now, just for argument's sake, there are some times where you can go over 50%. You can go to 56.99 on some FHA loan programs if you get total scorecard and an automated approval on it. But let's just use some easy numbers here. So if somebody says that, well, I only have $500 a month of other debt, and maybe that's a combination of credit cards, whatever that is, the total debt to income ratio on this one is going to be 50%. Okay, how do we get that? We've got a house payment, $2,000 a month. We've got other debts of $500. So we have $2,500 between house payment and other debts. $2,500 is 50% of $5,000. So that's your total debt to income ratio under this scenario. So here, somebody with no debt, 40% total debt to income ratio, $500 a month, 50%, $1,000 a month, 60%. For argument's sake, let's just say that 50% is the cutoff on somebody getting, that's the highest total debt to income ratio. And let's just say that the housing expense, that the cutoff here is 40%. So if the maximum amount of your house payment cannot exceed 40%, is this buyer here, here's a question, is this buyer here with a $500 per month car payment any more or less qualified than somebody who has no debt whatsoever? Well, the answer is no. So if this person said, well, if I pay off my car, will I qualify for more house? No, because you're allowed to have a certain amount of debt as a percentage of your income that's not going to hurt your ability to qualify. So do you have to be, so as somebody who's 100% debt free, a better buyer and going to qualify for more house than somebody who has a modest or normal amount of debt? The answer is no. You can typically have, the number here is about 8 to 10% of your income, okay, can be going towards other debts, and it's not going to knock you out of the purchase price or the range that you can qualify for. So if this person said, well, I just paid off my car, and guess what? They used their down payment money that they would have had for their down to pay off their car because they thought that they could get into a no money down program and qualify for more house because of that, they kind of shot themselves in the foot, okay? They'd have been much better off keeping that $12,000, $15,000 in the bank, keep that $500 a month car payment, and then get a better loan, right? Because somebody who has a down payment is always going to have a lower house payment than somebody who has no down payment. And most of the time, they're also going to get a better interest rate. So just to explain, this is kind of Mortgage 101, to explain how we get at what we call the front ratio or the housing expense ratio, and how do we arrive at the back ratio or the total debt to income ratio, and how your debt load may or may not affect your ability to qualify for more of a house. So I hope that's helpful to everybody. This is what we do all day long in the mortgage business. If you have any questions, push button, get Mortgage Professional, and I'd love to talk with you about your situation. Have a great day.